Hello, my name is Joe Hoyle, speaking to you from the University of Richmond, talking to you today about gathering financial accounting information. I know that in talking with college students, they often say that their ultimate goal is to own a business. And that's great. This is a country that was built on entrepreneurship and people starting businesses and developing them to large businesses. Our second video in this chapter is about your uncle and his business. He has started an office supply store and they sold stuff. And all of a sudden he realizes that he needs to keep information. He needs to have financial information. Now you might ask, why does he need information? Well, there's two very good reasons. One is he's going to have to pay income taxes. And the government is going to want to know how much income he made. So almost every business, whether they do anything else or not, has to have some way to create enough information so that the government knows that the amount of income they have made is proper and they're paying the right amount of income taxes. Second, it's likely that if his business continues to grow, he may need to borrow money from a bank. That's very common in the business world, is that you borrow money to help finance your inventory, or you borrow money to build a new building, or you borrow money to expand your building. Those things happen all the time. And the bankers are going to want to know if you have a successful business. They're going to want to know how your business looks. They'll need to see financial statements. Eventually, you might bring in other owners. And again, they will need to have financial information to decide whether they want to be part of your business or not. So a business has to have some way to gather financial accounting information. And your uncle has said, help me out. Help me know what to do. Well, one of the keys in getting financial information is to capture that information as soon as it happens. For example, if you buy inventory, you need some way to document that purchase as soon as it's made. If you pay for that inventory, you need to have some way to gather that information right then. Because if you wait, you'll forget or you'll make it wrong in somehow. So people who gather information make sure that the information is captured as soon as the event takes place. Whether it's a purchase, a payment, a sale, the collection of money, any of those things will help the business to keep that information. You then need some way to put that information into some form that you can keep. The information typically is kept in some type of a T account. So once you have the information, you have to analyze what the effect on your company was. Did my cash go up? Did my inventory go down? Did my liabilities increase? Did my equipment decrease? What was the impact in terms of ups and downs? But companies don't keep information in terms of ups and downs. They keep it in terms of debits and credits. Expenses, assets, and dividends increase with debits. Liabilities, contributed capital, revenue increase with credits. So they take that information, think about it in terms of ups and downs, but they have to translate that into a form of debits and credits, and they record that in a journal entry. So if I were to sell some inventory, I can record that through debits and credits in a journal entry. If I were to buy equipment, I can record that in terms of debits and credits in a journal entry. The journal then is a history of the transactions that a business has incurred. So if you went to a local store and said, let me see your journal, you could see a list of all their transactions, not written out in terms of nouns and verbs, but written out in terms of debits and credits. The journal, though, will not help you know the balances. It will tell you what happened, but it won't tell you your overall balance of cash or your overall balance of sales or your overall balance of salary expense. So that information is transferred into ledger accounts, the T accounts. The T accounts are kept in the general ledger. You'll have a T account for cash, a T account for accounts receivable, a T account for inventory, a T account for every account that you want to keep up with. You take the journal entries and you take each debit and you put it into the appropriate account in the T account. If you want to know what happened, you look at the journal. If you want to know a balance, if someone comes in and says, what's the balance of your rent payable? You go to the ledger and look at the rent payable T account, and that will tell you. If somebody wants to know what's the balance of contributed capital, how much do the owners put into the business? You'll go to the T account. You'll go to the general ledger. You'll look up the T account for contributed capital, and it will tell you. So, let's assume that you decide at some point to start a business. And you need to keep the financial information, again, so you can do your income taxes, get bank loans, or perhaps even get new investors. You first start off by capturing the information at the point it happens, document it through receipts or whatever. You then analyze it to determine what goes up, what went down. You transfer that into a journal entry in the form of a debit and credit. And those journal entries are historical records of the transactions. Those debits and credits are then posted to the T accounts. A debit to cash is reported as a debit to cash in the T account. If you then have no further entries to be made, you can take that information and you can literally make your financial statements. For hundreds of years, that's the process that accountants have used to start from the time an event occurs all the way through until financial statements are produced. In many ways, that's the accounting process. Have a great day. I hope you're making straight A's. Take care.